Hello everyone, welcome back to our channel. In today's video, we'll be discussing the psychology of investing and how to stay disciplined and avoid common traps. Investing is not only about numbers and data, but also about emotions and psychology. Understanding your own emotions and behavior is crucial for successful investing. I'll talk about 6 points: overconfidence bias, herding behavior, loss aversion, confirmation bias, FOMO, or fear of missing out, and anchoring bias. Let's get started. Point 1. Overconfidence bias. One of the most common traps that investors fall into is overconfidence bias. This happens when investors believe they are better than average at picking stocks or timing the market. However, research shows that overconfidence can lead to excessive risk-taking and poor investment decisions. To avoid overconfidence bias, it's important to stay grounded in data and analysis. Remember that no one can predict the future with certainty, and that investing involves a certain degree of risk. Point 2. Herding behavior. Herding behavior is another trap that investors fall into. This happens when investors follow the crowd and invest in popular stocks or trends without doing their own research or analysis. To avoid herding behavior, it's important to do your own research and analysis. Don't follow the crowd blindly, but instead, focus on your own investment goals and strategy. Point 3. Loss aversion. Loss aversion is a natural human tendency to prefer avoiding losses over making gains. This means that investors are more likely to hold on to losing stocks instead of selling them and cutting their losses. To avoid loss aversion, it's important to have a clear investment strategy and stick to it. Don't let your emotions cloud your judgment, and don't hold on to losing stocks for too long. Point 4. Confirmation bias. Confirmation bias is the tendency to seek out information that confirms our existing beliefs and ignore information that contradicts them. This can lead to poor investment decisions, as investors may miss important information that could impact their investments. To avoid confirmation bias, it's important to stay open-minded and consider all information, even if it contradicts your existing beliefs. Don't let your biases cloud your judgment, and always stay objective and rational. Point 5. FOMO, or fear of missing out. FOMO, or fear of missing out, is a common emotion that investors feel when they see others making money in the market. This can lead to impulsive and irrational investment decisions, as investors may jump into hot stocks without doing proper research or analysis. To avoid FOMO, it's important to stay disciplined and focused on your own investment goals and strategy. Don't let short-term trends and hype influence your decisions, and always do your own research and analysis before investing. Point 6. Anchoring bias. Anchoring bias is a tendency to rely too heavily on the first piece of information that we receive when making decisions. This can lead investors to hold on to stocks that have performed well in the past, even if they are no longer a good investment. To avoid anchoring bias, it's important to continuously evaluate your investment portfolio and adjust your strategy as needed. Don't hold on to stocks just because they have performed well in the past, but instead, focus on their current and future potential. That concludes our discussion on the psychology of investing. Remember, investing is not only about numbers and data, but also about emotions and psychology. By staying disciplined, objective, and avoiding common traps, you can make sound investment decisions and achieve long-term investment success. Thank you for watching. Don't forget to like, comment, and subscribe, and I'll see you in the next video.